Hello, and welcome to this James Cooper Creston webinar on IHT planning for the proposed changes to business property relief as they apply to owners of family companies, i.e. shareholders in family companies. My name is Alex Nicholson, and I'm one of the business tax partners here at James Cooper Creston. We're a medium-sized firm of accountants and business advisors. If I could have the first slide, please. So I thought I'd start this webinar just with a few images that have been taken from the recent press. And I just wanted to make clear at the outset that we are dealing with the same tax issues here that have proved to be such an emotive issue for farmers. I think the point that's been less widely understood is that actually these proposed changes impact on all business owners potentially, and therefore it's not just farmers that might be impacted. So what's it all about? If I could have the next slide, please. So these changes were announced in Budget 24 at the end of October. And as I said, there's proposed changes to business property relief and also to agricultural property relief, with the latter, of course, being the one that is impacting on the farmers in the main. Essentially, what we're talking about here with these changes is the replacement of an uncapped relief, an exemption from inheritance tax, with a capped one. So under the current regime, the value of assets which qualify for 100% business property relief is unlimited. And my understanding is that when this current regime was first brought in, the policy objective really was to avoid the breakup of family businesses on death of the proprietor. So what this means in the context of our owner-managed company is that most shares in unquoted trading companies qualify for 100% BPR once they've been held for 2 years. That's the current regime. From the 6th of April 26, there will be a new £1 million BPR APR allowance on which 100% relief is available, with the excess qualifying for 50% relief. This means that there's a 20% IHT liability on qualifying BPR APR assets above the first 1 million for each individual. It's also worth noting that that 1 million allowance is not transferable between spouses. So as I've already said on the previous slide, all business owners should consider the impact of these changes, not just farmers. And the focus today is on owner-managed companies in particular. So if I could have the next slide, please. I thought it would be useful to highlight these changes by way of a simple example. So I'm assuming I've got a family-owned trading company by Rob and Irene, who are husband and wife, and they own it 50-50. They're in their late to mid-70s, and perhaps still active in the business, but winding down. And we may have a situation where their son and daughter, adult son and daughter, are taking over that business, but are not yet shareholders in it. I've also put on there that Rob and Irene have mirror wills. So if I could have the next slide, please. In my example, I'm assuming that the first death is Rob passing away. And because they have a mirror will, the terms of that are that Rob leaves everything to Irene. There would be no IHT in those circumstances because that's a transfer between spouses on death, and that's exempt from IHT. So we then roll forward to the second death, and this is where we see the impact of these changes. So Irene passes away. The position now, and up to the end of the current tax year on the 5th of April 26, is that if Irene passes away in this period, then we would expect 100% business property relief still to be available. So the entire enterprise value, the value of the company of 4 million, is exempt from inheritance tax completely. From the 6th of April 26, there will only be a 1 million 100% relief. So that takes 1 million out. And then we have 50% relief on the value above 1 million, i.e. on the remaining 3 million, which takes another 1.5 million out of inheritance tax, leaving 1.5 million of the value of the shares within the IHT net and giving rise to an IHT liability of 600,000. So what we see from this then is we move to a position from having no IHT liability to quite a significant one. But in particular, you see in this simple example, Rob's 1 million allowance has been lost because, as I mentioned, it's not transferable between spouses. And in this way, it differs from the normal 325k IHT nil rate band that applies to every individual and which is transferable between spouses. It also raises the question of how to fund the IHT payment. If I could have the next slide, please. So the key message really that I want to convey today in this webinar is to review your affairs, to understand the impact of these proposed changes for you and for your family. Only then can you consider mitigation strategies, which is what I'm going to focus on now for the rest of the webinar. Well, the first bullet point on the slide here in terms of mitigation strategy, I guess isn't really mitigation because it's do nothing. And there are two reasons why I could think that you might want to do nothing. One is that the value of your business is under £1 million and you don't anticipate it's going to be more than that, or it's widely held and the value of your share is not likely to be over 1 million. Or two, if you're looking to sell the company at some point in the future before your death, clearly then you won't hold the shares that would qualify for business property relief, and normal IHT planning would be appropriate with the cash that you might have received. So that's the do nothing option. In most cases, and as a minimum for couples, whether those are spouses or civil partnership, I would suggest that you do please review your wills to seek to use the 1 million allowance on the first death. Clearly, there's a £200,000 potential IHT saving through doing so. I'm no lawyer, and clearly legal advice will be needed in respect of reviewing wills, but I understand that the use of a flexible will trust, whereby on the first death, that person's assets are left into a trust, it could be a means that will achieve this, as it will allow your trustees to decide how to distribute assets, and they could then distribute them in a way that will seek to use that £1 million allowance. The other three bullet points here then, lifetime transfers, changes to company structure, and some pre-6 of April planning opportunities that may be right in some circumstances, we'll now go on to consider. So if I could have the next slide, please. So what is a lifetime transfer? Well, it is really what it says it is. It's transferring ownership, in this case of shares, during your lifetime. So if you make a gift or a transfer of shares to an individual, a family member, say, that is a potentially exempt transfer, a PET, for IHT purposes. Provided you survive for at least 7 years from the date of making that gift, there will be no IHT on the value of those shares when you pass away. So for transfers before the 30th of October 24, that was the budget day, there's no changes to that position. And there will be no BPR restriction if you pass away within 7 years on a gift you made before the 30th of October 24. This, of course, assumes that the wider conditions are for business property relief are still met at the time of your death. Essentially, the position is retested on death, so the individual still needs to typically own the asset and it still needs to meet the BPR conditions. So that's not treated as using any of the new 1 million allowance. For transfers from the 30th of October 24, though, in applying the 1 million allowance on death, any business property PETs and also chargeable lifetime transfers in the previous 7 years are taken into account. So if you give away, say, 5 million of assets now, and you pass away in 1 year's time, then that 1 million allowance will apply and IHT potentially could be due on the other 4 million. A chargeable lifetime transfer is different to a PET and typically refers to when you settle assets into a relevant property trust, otherwise called a discretionary trust. The point that's also worth making here about lifetime transfers is that IHT taper relief applies from years 3 to 7. So provided you survive for at least 3 years after making the gift, the rate of IHT will start to taper down, with the taper increasing between years 3 to 7. On lifetime transfers, and partly because of the taper, you might also consider some sort of term insurance to cover the IHT on death. Clearly, the cost of such a cover will depend on your age and your health at the time that you make such a gift. But of course, because it is only for a period and it is a decreasing risk, it can be quite affordable in the right circumstances. If I could have the next slide, please. The other points I want to make around lifetime transfers are not so much IHT related, but are capital gains tax related. And there's two specific issues or points that I wish to try and get across here. One of the plus points about holding on to assets until you pass away is that whilst they're potentially subject to inheritance tax, you do get a capital gains tax base cost uplift to the market value of those assets at the date of death. What this means is if the recipient of that asset then sells it on fairly soon afterwards, and if there's been no increase in value, there will be no capital gains tax to pay. So that's lost on lifetime transfers in most circumstances. The other point then around lifetime transfers is that, and capital gains tax, is that a gift of shares is a disposal for capital gains tax purposes, and that's deemed to be at market value. However, in our trading company scenario, there is the potential to hold over that gain such that no capital gains tax becomes payable and the recipient of the shares takes on your base cost of that asset. However, there are some quite complex rules around all of this, which require careful consideration in order to ensure that you don't get caught out. In particular, I make the point that the trading company definition for business property relief is not the same as it is for capital gains tax relief. Capital gains tax relief is that the rules are generally a bit stricter. There will also be a restriction on the ability to hold over gains if the company has non-business, i.e. investment chargeable assets. For an example, say, if surplus profits have been invested into an investment property or perhaps a portfolio of stocks and shares. There's also some strange quirks in the legislation, which you just need to check and which I won't go into in detail here. If for any reason CGT holdover is restricted, then one of the things you might look to do instead is to consider a gift to a relevant property trust, which we will come on to in a minute. But this is because this has the option to hold over any capital gain where you're making what is potentially a chargeable lifetime transfer to a trust. There are some other pieces of legislation that will also need to be considered. I mentioned employment-related securities on the slide. It's just something to step through. In most cases, it won't give rise to any tax liabilities, but nonetheless important to consider. If I could have the next slide, please. So I also mentioned that you might consider a change to your company share structure in order to look to maximise effectively the 1 million 100% BPR. There's lots of different permutations and possibilities with company share structures, but in this context, it's likely to include some form of freezer share or growth share. We'll come on to look at an example as to what I mean by those terms in just a minute. The point I wanted to make before doing that, however, is that ownership of a company and its operation can be segregated. Broadly, company ownership is via its shareholders, and the company day-to-day operation is via its directors. So even if you're giving shares away, it's perfectly possible that you could remain as a director and still be responsible for the day-to-day operation. Clearly, if you're going to do any of this sort of structuring, you will need to think about all the rights that sort of attach to a class of shares. So that's capital, voting, and dividend rights. There are also certain anti-avoidance provisions to navigate, as there always are in tax. But I said I'd try and illustrate this with an example. So if I can have the next slide, please. So we've got a similar assumption here, really. I'm again assuming I have a husband and wife company and they own some shares 50-50 in it. And what this type of planning through freezer and growth shares might look like is where we effectively reorganize the existing shares so that the husband and wife have freezer shares. And the daughter and son, in this example, have growth shares. So if the value of the company is, say, conveniently £2 million today, we would cap the value of the shares held by the husband and the wife at £1 million each. When I say cap, I mean, in the event that the company were to be wound up or there were to be a disposal, those shares would never benefit from more than £1 million each. Clearly, if the value of the company today is more than 1 million, then you wouldn't necessarily look to lock all of the inherent value in the company within those freezer shares, and some of it might be passed on with some other shares to the son and the daughter. But in principle, what you're then looking to do is to put future growth in value into the shares that are held by the daughter and the son in this example, i.e. growth shares. And of course, the idea being that then sits outside of the estate of the husband and wife, mum and dad, for inheritance tax purposes. You would then also, of course, look to structure the wills correctly to make sure that 1 million allowance is used on those freezer shares with the maximum CGT base cost uplift. So that's a very broad example of how growth and freezer shares might be used to take advantage of the 1 million allowance and to limit the impact of these proposed changes. In reality, there will be lots of different options that might be considered, and there would need to be family discussions as to what's the right way forward for a particular family. That's all I'm going to say on that subject. So if I could have the next slide, please. I'm just going to very quickly talk about relevant property trusts. So as I said, this is also often referred to as a discretionary trust. And essentially what happens is the settlor will transfer shares into a trust, and they're excluded from benefit, but they could be a trustee, thereby retaining, in effect, the voting rights and control that those shares could bring. And the beneficiaries of the trust would typically be family members. So it could be children and remoter issue typically. So it effectively creates an additional shareholder in the company, which can be quite useful in certain circumstances when IHT valuations are considered, because minority interest discounts can apply. It's quite a specialist area, this. I'm not a trust specialist, but I think a couple of points I just wanted to try and convey is that the trust created from the 6th of April 26, the trustees will have their own 1 million BPR APR allowance, albeit applied over 10 years and not 7. So this is a way of locking in, if you like, an additional 1 million BPR APR allowance. And there's also the possibility of some planning between now and the 6th of April, because pre-6th of April transfers of qualifying assets will not be subject to this £1 million allowance. And what this means is that, provided the assets qualify for business property relief, they could be transferred into a trust without any chargeable lifetime transfer occurring, IHT on transfer in, and with the ability to hold over any capital gain arising. There's already proposals around various anti-avoidance provisions to stop people looking to fragment things into lots of different trusts. But as I said, this is very much a specialist area, and I've got colleagues that advise in this. But relevant property trusts do have their own tax regime, including periodic 10-year IHT charges. But in the right circumstances, they certainly have their place. Something to consider. Next slide, please. And penultimately, really, before I move on to summarise, I just wanted to talk very briefly about funding of IHT payments. HMRC has now confirmed that where BPR APR is available, there will be the option to pay any inheritance tax liability via instalments over up to 10 years. I believe that's equal instalments per year, and that will be interest-free. I think possibly this is something that has been announced in order to appease the farmers somewhat. Other options might be to retain funds in the company and look to extract those funds via a company purchase of own shares, i.e. the company will fund its own inheritance tax liability. You could also look at life insurance policies written into trust. So effectively, these would have a surrender value and that would then be used to fund IHT liabilities on death, And by writing them into trust, it's possible that they can sit outside of your estate for inheritance tax purposes. Next slide, please. So in summary, it's really a call to action today. As a business owner, you should consider what these changes will mean for you. Whether you just want to consider the changes to BPR or actually undertake a full IHT review will very much depend on your circumstances. There may be various ways in which the impact of these changes can be mitigated, but there are no two situations that are the same, and therefore there's no one solution that will fit all. I should also stress that at this point in time, we are dealing with proposed changes. There is no draft legislation, which is expected later on this year. And the government has recently concluded a consultation, but we haven't actually had the response to the consultation as yet. So further detail is awaited. As I've explained, certain trust planning opportunities may exist in the right circumstances up to April 26th. But those will be more limited beyond that date. So please do consult your trusted advisors. You will require both tax advice and legal advice to form an effective plan for this. And the final point I make is that there will be a need to engage in family discussions. Today, obviously, I focused on tax, but I appreciate that in any family situation, there will always be lots of other factors to consider. And it's about working with trusted advisors and the family to find the best solution for your needs. So I think that brings me to a close. If I could just have the next slide, please. Shown there are my contact details. If anything has been of interest today and you want to talk about it some more, then I'd be delighted to hear from you. So please do get in touch. Thank you for listening.